All right. Hey, everybody. Welcome to the Startup Growth Podcast. I'm your host, David Phillips, the CEO and founder at Fondo. And today we have a very special episode. We have Nathan Latka, the founder and CEO of FounderPath, where they have invested over $200 million across 500 software companies. Super excited to have Nathan on the show today. He's going to talk about his career as a founder, starting out building an agency, turning it into a SaaS company, which he raised venture capital for and ultimately sold. We're going to talk about building media businesses. We're going to talk about how to get attention online today with so many distractions and why attention is so valuable in today's AI-driven market. So without further ado, we're going to jump into this episode with Nathan Latka, the CEO and founder of FounderPath. And before we do, I just want to tell you about my company, Fondo. Fondo helps companies put their accounting on autopilot. So if you need your financial statements, you need your taxes filed, or if you want up to $500,000 back from the IRS, join over 1,000 companies like PostHog and 11 Labs and check out Fondo today at tryfondo.com. Let's get into it. Awesome. So we've got Nathan Latka here today, the founder and CEO of FounderPath. Excited to have you, Nathan.
Thanks for having me, David. Yeah, it's super cool. I came into Industrious here and I said, what's that big blue logo? Oh my gosh, is that David? I shot you a text and you said, let's record. So here we are.
Here we are, impromptu.
Yeah.
So yeah, thank you. But yeah, would love to go back to the early days of Nathan as a first-time founder and, starting Heyo. Can you tell us about sort of that first startup experience that you had and how you got started?
Mm-hmm. Yeah, well, we were trading war stories and I'm wondering how many of you guys, it sounds like we all started building Facebook pages or Facebook profile pages, but Heyo I was studying architecture at Virginia Tech. I realized I liked money too much and architects were broke. I said, I better learn how to code. So I looked up how to write FBML, Facebook Markup Language, and I started launching these custom fan pages for folks. And that was my first foray into software. I quickly learned I hated charging $600 per profile. And instead that morphed into, let me build a tool where they can build it themselves and they pay me a recurring fee. That's how I stumbled into SaaS.
Wow. So this is like original SaaS back in the day. And so were your customers... okay, so this is with the fan pages, and then this morphed into Heyo.
Exactly. Okay. Yeah, it's traditional model, right? Go from agency. Now, I was a very small agency, but it went from agency to SaaS. Yeah, and that's like a cheat code, right? If you're trying to get into SaaS, the best way to do it is start an agency.
Wow. And so, how did you get your first Heyo customer?
The first Heyo customer came from me emailing everyone I put together a custom profile picture for, saying, "Do you want to do this yourself? It's $30 a month to use this software." And that's how it started to take off.
Okay, wow. And so you started the company. Ultimately, you were serving thousands of customers.
Yeah. Our ARPU was about, now this is going off memory, right? Because I'm 35 today, and I launched this company when I was 18 in my dorm room, Virginia Tech, Behringer Hall. If any Hokies out there, go Hokies.
Go Hokies.
Go Hokies. But it was, 4, 5, 6, 7. We bootstrapped $2 million in ARR.
Wow.
At the peak.
And did you raise any venture capital for this company?
We did. So once we hit about $1 million of ARR, our last round was a $2 million on an 8.5 pre, so 10.5 post. David Cohen at Techstars was in that round, etc. I shouldn't have raised money. He was great, interesting, but I raised too much money.
Oh, interesting. What would you have done differently?
Well, so maybe 6 months after we got that Series A done, and I got a $6.5 million all cash offer from Ryan Ellis at iContact to buy Heyo. And I'm going, I'm 21. I still know the company. I'm rich. This is great. I don't have to do anything for the rest of my life. I go to the next board meeting. Sure, they're going to say yes, right? But I just told you guys, right? It was 10.5 posts. So if I bring you a $6.5 million offer as an investor, are you going to say yes or no? You're going to say no, because the acquisition's under the valuation you just put money in at. Right. And that's when I said, whoa, I lost a lot of optionality raising money. It's not that VC is bad. It's just I didn't know how much optionality I was giving up.
And ultimately, you did end up selling. Is that right?
For a fraction of the price.
Wow.
We ended up exiting. It was like a slow death, right? We peaked at $1 million of ARR and we were shrinking by like 10% year over year for like 3 years. I kept trying to stick with it. And I was so nervous. I was going to let my investors down. It was the biggest mistake of my life. Your 20s, your 30s, they're the best years of your life. If you realize something's not working, you've got to know how to cut bait and move to the next thing. I should have sold 3 years earlier.
Wow. And how did you take that experience with with what you did next, because then you started GetLatka, and tell us about that.
Yeah. So once I went through all this with Heyo, I learned there's a lot I don't know about building a company. And I started just cold emailing founders, doing the classic, "Hey, David, can I take you out for coffee?" And of course, no one replies to those. I go, "How do I reposition my subject line to get responses?" I said, "David, I have a top podcast. I'd love to feature you." And David says yes. And so I'm like, "Oh, I need a podcast." That's how I get meetings.
Wow.
That's how the media brand, which eventually turned into what is today GetLatka.com, got created. So yeah, that was the wrap on Heyo. And it's fun. You guys can actually see my tax return for Heyo in my book on page 6. I stuck it in there. The lawyer said, "Nathan, you can't do this." I said, "I'm doing it." So page 6. And page 243 is the $6.5 million LOI. It's the real thing in there. But that all launched the media brand in GetLatka.
Wow. And so, okay, so you walked away from millions of dollars because of your VCs. They kind of forced you. And how do you advise entrepreneurs now that are considering raising money? Like, what should people think about when they're raising that seed round, and what optionality do they give up?
Yeah. The way I think a lot of founders view the fundraise as that is the success, but really what you've done is you've optioned your future. You have decreased the amount of buyers because they have to pay enough to make the VCs happy to just put money in, right? So you're just playing a different game. So it's people mistake sometimes when they hear me, they go, "Nathan's anti-VC." No, I say most founders just don't realize it's a different board game. It's Monopoly versus Catan. You just have to know what board game you're playing, know the rules, and then go all in. Try and win with those rules. It's a different set of rules, though.
Yeah. And so what are, okay, so let's go back to Heyo. If you didn't raise money, you could have sold for 6.5 at least.
Yes.
And now that you raised money, what was the minimum that they would be willing to let you sell for?
Well, something higher than 10.5 million. We never had that conversation where I got a real answer from them, but it would have to, you know what VC's trying to get to today, right? They need a, 10x on some company to return the fund, or sometimes now multiple companies to return the fund.
Yeah.
So it's a big number.
And how much do you think founders are thinking about this VC math when they raise their seed round, right? Like, are people thinking about that?
I don't know the answer to that. I think, what's interesting, VC was created, call it 15, 16, 17 years ago because software was expensive to build. You had to go buy servers and things. That's not expensive today. You go to Cursor and Level and have an app in 2 minutes, like no servers. So the whole use case of why VC was created is totally not how it's being used today, right? In terms of the capital need. Again, I think what's happening is a lot of these founders raise this money as a social indicator to the world, and they do it to help them attract talent. It's not because they actually have a hard cost that they need to get started up. So I don't think most folks raising seed rounds are thinking about the stream optionality they lose, but I think more will in the future.
Yeah. And so now fast forward to GetLatka, and your open rates went up pretty significantly, it sounds like, from coffee to come on my top podcast.
Yeah.
And this kind of goes back to the Facebook fan page stuff, like developing hooks, right? Like that becomes so important for everything you do as a founder. And I feel like you've mastered that to a level. Can you share a little bit more about, advice on how to think about hooks, in this world where you have such limited time to get attention?
So what we're just talking about, obviously, it's so easy to write software now. The winners are going to be the ones that know how to keep attention, get it and keep it. And so I just spend a lot of time, if I'm scrolling through my emails and someone gets my attention, I store the subject line. If I'm scrolling through my texts, even if it's my mom, I'm just looking at only the preview version and something catches my attention, I literally store that thing. The last mass text I sent to my list, I was scrolling through my list. You know how when you get on iPhone, if you like someone's text, it says David liked, and then it puts in quotes what you liked.
Yes.
So the last text message I sent, it said Nathan liked 1 million of revenue in quotes. So when someone saw that, I go, wait, did I text Nathan 1 million of revenue and he liked it? And you open, it's actually my message blast. Super high open rate though.
Wow.
Because you just have to be a collector of hooks. The best way to be a good hook writer is to be a good hook consumer.
Yes. Okay. I love that.
Yeah.
I love that. And so now, thousands and thousands of founders are coming to GetLatka to learn more about companies. Is that right?
Yeah. We get about 3,000 clicks organically per day from Google.
Wow.
Yeah.
And so what kind of what kind of information do you like to share through GetLatka?
So GetLatka was because I got addicted to doing the podcast. And once I had recorded about 300, 400 episodes, people would ping me and say, Nathan, I just found your show, but there's so many, where do I start? And I'm like, oh man, I need to take every CEO I've interviewed, all their audio, and tag it to categorize so that new listeners can search quickly. And the question is, what do I tag it with? Okay, well, revenue would be a good answer. So I ask every CEO, what's your revenue? So that's how I categorize it. And so now the number one search term, it's programmatic SEO, GetLatka. If you search like Notion revenue in Google, GetLatka will come number one.
That's right.
So it's just that programmatic keyword combo.
I mean, that is, I think as a company, you're always trying to benchmark yourself. You want to know how you're doing against the market. And I found that GetLatka is the place to go and find out revenue of actual other companies.
Yeah. If you doubt any data points, you can click it and hear the CEO's voice saying it.
Nice.
So if it's bad data, it's not me. It's CEO live, but it's not me.
Awesome. And then so you continue to build that, and now you're working on something really interesting. And so you've funded hundreds of companies now. Can you tell us about how did you come up with the idea for FounderPath and where you're at?
Yeah, so FounderPath today is a debt fund, I think venture debt for software companies exclusively. And it wasn't my idea. What happened was, as I was doing the podcast, I started asking founders how they're capitalizing their business. And some of the really mature founders I had on, like Henry Schuck at ZoomInfo, who's a star now public, was just bragging almost about how effectively he used debt to buy other companies. And I'm like, I didn't know this was an option. And so I started looking, going, whoa, debt is a good alternative to VC. And so I started doing debt deals in 2018, small 10K checks. Fast forward to today, we're investing out of our third fund. We've deployed $200 million of capital to about 530 software companies over the past 3 years.
And so if I'm a software founder and this is sort of a new path, right? Like VC is sort of the path I know and read about all the time. Venture debt feels inaccessible, right? Because I think, I need to raise a Series A or a Series B before I can even access debt. But that's not necessarily true. So what stage can people access debt? And what numbers do they need to optimize for to access debt?
The term venture debt was really popularized by the banks like SVB. And it's because SVB would bank a startup that just got 20 million Series A, and they would lend against that VC firm, the venture putting the money in. So they're not lending against the fundamentals of the business. They're lending against the equity sponsor and the cash balance at SVB. The difference between what we're doing is we don't care about the sponsor. We look at your underlying metrics: net dollar retention, churn, ARPU, CAC, burn, runway, rule of 40, EBITDA, net income, all these things. And if you have a sponsor, great. But we underwrite you based off how you're performing as a CEO and the metrics. And so our typical deal today, we require at least $1 million of ARR. Our average borrower today has about 8 million of ARR. Largest is at like 60 million, smallest is at 1 million. And our most popular product is our term loans. So we give you between 1 million and 6 million. You pay back over 1 to 4 years, no personal guarantee, no warrants, IO period, sometimes interest only, etc.
Very nice.
Yeah.
I think it's a great option for founders because you can invest in hit the growth metrics you want to hit to raise the next financing, either through venture or continue to take debt, continue to grow the business and actually own it so that you can make money when you sell it.
That's the idea. Or do a secondary.
Yeah. So how does why is secondary such a bad word? And it's so nobody knows about it.
Secondaries are how founders like you guys watching can convert your paper wealth into cash in your personal bank so you can go start a family, buy a home, go on vacation. Most investors, the common belief is you want founders to stay hungry. And if you let them take secondary out, they're going to lose their hunger. We have seen the opposite. I have the data, right? Because borrowers have to stay connected to our platform. When a founder has their personal stuff taken care of, they have $1 million in the bank, they take way bigger risks at the software company and they generally pay off, right? And growth accelerates. So I think every founder raising capital, if you're going to go play the VC game, you should always put in your initial conversations with every potential investor, hey, when you send me indicative terms, please note that others are offering me a percentage of the round to do a secondary. Please include that in your term package. Just set the expectation up front. There's going to be a portion of the total dollars raised as secondary.
That's great. I mean, because so many founders, I mean, 99% of companies fail, right? Or 90%. And VCs are capturing all the value, right? If you think about the companies, the value that's being created by the company, by the founder and the team, like who's capturing that value, right? Like you get the paper markup, but the VC can kind of monetize that through raising another fund, management fees, but founders often don't, right? And like, I think it sucks to see so many founders put their life into things and then, never take secondary or get put in a position where they can't sell because the VC won't let them block a sale. So that's really interesting.
The VCs have their place. I mean, they've created some amazing companies, but you just have to know, are you playing Monopoly or are you playing Catan?
Yeah.
And play accordingly.
And anything exciting for you in the secondary world or,
Yeah, I mean, there's 3 big trends happening right now with AI, right? And specifically things like Cursor, Lovable, VO. And the 3 trends are we're moving from, giant teams to tiny teams with giant revenue, high revenue. I'm talking million of ARR per employee. So small to big team, big to small teams. The second is we're moving from, Google search has trained all of us to type in a question, a chat interface. It's just we haven't been getting answers back. We get a bunch of links back and summaries of Google search. Everyone's going to expect in your software dashboards to be chat interfaces, just like the LLMs in 2 years. It'll be the norm. So that's the second big trend. And the last big trend is, we are betting on companies not that build the best technology, but that have the best distribution and know how to get attention. Because it's worth more than good tech. The best product doesn't win anymore. So those are the 3 trends that we're betting on. And because of that, we believe that there are going to be, instead of today, there's 150,000 software companies in the world. We scrape G2, we scrape other review sites, we put a poll list together. We think there's about 150,000. I think there's going to be 500,000 in 2 years. Everyone's got a software company. But the question is, everyone's net worth is going to be stuck in their software company. Because you can't really access growth equity in a secondary until you're at like 10 million of revenue. But 99% of these companies are going to be doing 3 million of revenue with a 2-person team. How are they going to get cash? Like the bank, you ever tried to go get a mortgage running a software company, and what does the bank say?
Yeah, it's impossible.
Yeah, it's like, show me your pay stub. And you're like, what do you mean a pay stub? I run it, I just raised it at 20 million valuation. Like, can't you value that? They don't get it. So we've launched a tool at FounderPath where we're effectively pricing your common shares every morning and saying, David, hey, you added 2 new customers last week. Your common has increased from, I'm making this up, $9 a share to $13 a share. Would you like to sell some right now? And we'll buy it instantly and deposit the money in your personal bank account.
That's pretty incredible.
Yeah.
And where can we find out more? Where can we follow you? Where can we find you guys?
Yeah, if you want to learn more about like my backstory and where I screwed up, you can check out my book, How to Be a Capitalist Without Any Capital. If you want to learn from other great founders like David, you can check out my podcast, Latka. Just search my last name on iTunes. And if you want some capital, debt to grow your business or test the secondary product, David, they can find that at FounderPath.com.
Awesome, Nathan. Well, thank you so much for being on the show.
We're rooting for you guys. Appreciate you, David.
Thanks, Nathan.